Hi guys, thanks for tuning in to another episode of Nuggets News. Today we welcome back another friend of the channel, Steve Keen, who we've had some great chats and we had a debate about Bitcoin once, but today I want to talk about what the central banks have been up to, how the world economies are unfolding. So how have you been, Steve?
Very well. Overworked as usual. I used to joke that I wanted to retire so I can get some serious work done. I've done the retirement bit and I'm doing too much serious work.
I sometimes feel that way as well. But what has been happening, particularly the US markets, is often the focus of everyone. And they did a big pivot or U-turn, I believe, when they went from talking about raising rates to really backing off and saying, look, I don't think there's going to be many more rate rises. So where do you think the US and world economies are kind of standing in terms of what they're doing now with rates and monetary policy?
Okay, the first thing to get through is they don't have a bloody clue where they are. Okay, they're like explorers with a map of Mars, where they're actually on Venus or the Earth, and they have no idea of the terrain. And the key way in which they do is that they have no idea of the role of private debt or credit in macroeconomics. And I'm just actually doing a piece largely on Australia right now. So this is a bit of a personal story that turned into a exposition of economic theory as well. And I've been reading papers written by two leading Reserve Bank of Australia researchers. And one of them is literally titled, I've just shut my system down before we started doing this talk, as you know, but I'll see if I can bring it back up and see the title of the paper. The paper is literally called The Role of Credit Supply in the Australian Economy. Now, you might think that would mean they look at credit supply. Oh no, they've got one graph that shows credit supply, and you eyeball it, and it's clearly strongly related to aggregate demand, to GDP, change in GDP. They don't do anything with that data. They instead look at what they call credit conditions, which is how easy it is to get a loan, according to the results of a survey they run. They completely ignore the level of aggregate debt. There's another paper out, and I love this. So, I can't help being satirical here. It's too inviting. It's another paper out by a guy, one researcher called, I think is Alex Saunders, and the other is Dr. Tulip. Okay, so Dr. Tulip and his collaborator have put out a paper called A Model of the Australian Housing Market. That model completely ignores the role of credit. Why? Because they said they've done research in it and they found that credit conditions have no role in prices. So their survey data, which is how easy it is or difficult it is to get a loan, doesn't correlate to the data. Therefore, they ignore the credit conditions, but they also implicitly ignore the volume of credit. So this is not just a problem with the Australian Central Bank. The only central banks that actually have any serious acknowledgement of understanding the role of credit and their evolving ideas about it are the Bank of England, which has absolutely nailed the role of banks in creating money. The Bundesbank, much to my amazement, has also jumped on board and saying banks create money. To some extent, the Bank of Norway. Okay, those three, I know, are doing some research where they are looking at the role of credit in some sense. But the Australians, except for one member of the staff who's more au fait about the role of credit, given research he did into the 1890s housing crash in Australia, they're just blind to this information completely. So what you have is the blind trying to analyse the economy and saying where it's going. Now, what they're blind to is the level of private debt and the rate of change of private debt, which is what creates money. And nobody borrows for the sheer pleasure of being in debt. So when you borrow to spend, and that is added to demand from the turnover of existing money. They have no idea about that. Okay, completely blind. Therefore, they're trying to say how to change the economy as if the level of private debt and its rate of change have no role in the economy.
So what do you feel are the most important metrics? Is it private debt to GDP and our economy growing? Or is it private debt to personal income for the individual person to be able to pay down their debt? Or what do you think are the most important things, particularly where we see Australia?
Yeah, it's if you're looking at GDP, then when you look at personal income, you're looking at a subset of GDP. And so I basically just use GDP data because it's, pardon me, it's more aggregated. It's what I want to work with at the level of economic modelling.
Yep.
And what you have is, it's like in Australia's case, and this is using Reserve Bank of Australia data on this front. I'll just actually, pardon me, spending a bit of time to bring up a data chart here. But in the Australian economy, the level of private debt as compared to the ratio to GDP hang on, pardon me, has risen from,
We did cover this recently in our documentary as well. I can't remember off the top of my head now.
40% at the end of the Second World War to 200% at its peak, and it's down about 180 and 95% now. And that data is recorded by the Reserve Bank, but completely ignored in how they analyse the economy. Now, my point of view, you've got to take it into account. When you've got that much debt, you're going to have very little credit after a crisis.
So just to simplify this for people at home, what a lot of these central bankers and researchers are saying, that if we just make credit more freely available, everything should be okay. And they're ignoring the fact that a lot of these households are tapped out. They've already got a $1 million mortgage, credit card debt, car debt. They're not just going to take on more credit just because it's freely available, are they?
No. And they're also, and what the Reserve Bank ignores, and this is classic for economists, is they ignore the level of private debt and the credit as well, because they say all it is all credit is, according to them, is a pure redistribution of spending power from one person to another. And this is actually pure redistribution, is a quote from Ben Bernanke, dismissing the debt deflation theory of the Great Depression that Irving Fisher developed in 1932-33. And what he said is that what they're saying is, when a person borrows money, the borrower's spending power goes up and the lender's goes down. And then when you repay it, vice versa. So you're basically staying at the same level, who's up in the seesaw is changing, but the height of the seesaw doesn't vary. And that's their thinking about credit. Therefore, it plays no role in the macroeconomy. Now, once you acknowledge that banks actually create money when they lend, that becomes a fallacy, because if you have if I lend to you, and I've actually been through a personal experience of this just recently, my spending power goes down, yours goes up. If you repay me, vice versa, and I'll spend when you repay me, even if rates are very high, rates are very low, it doesn't matter. I've still got my need to spend. But if if a bank lends money to you, its assets rise and its liabilities rise as much. And the liability side is money, and that's what we spend. So the amount we have to spend increases. And the person who takes that first loan out doesn't borrow for the fun of being in debt, they borrow to spend. So that increases the spending power. And so you actually get, the way that and I've done this mathematically, so my little conclusion is that their vision is aggregate demand is the turnover of existing money. That's classically Milton Friedman's velocity theory of money. Velocity of circulation times the amount of money gives you nominal GDP. My argument is it's velocity of existing money times existing money plus the change in debt, because the change in debt creates new money which you spend, and when it's first borrowed, it is to spend that money. Yep. So total demand includes this change of money, which is change of debt initially, and that is, in the Australian case, has been as high as 25% of GDP.
Yeah, and
they're ignoring it.
And they're talking about credit impulse. I think a few other people refer to this as well. But how is it possible for this to continue to grow? It's only with good demographic trends and strong migration, or do you think that most developed economies now are kind of past that point where they can keep growing debt? We're sort of up that exponential curve.
We're already well past it. I mean, it might be worth me, again, I'll just do this in the background before I actually bring it up. I'll bring up some charts that I'm working on right now so we can show people what I'm talking about. But because conventional economic theory ignores money, debt, and banks completely, then they've built models of the economy that they've fitted to the real data that don't include those elements. Now, when you fit those models way back in the past, when, say, like in America's case, let's say in 1945, private debt was roughly 30% of GDP, and therefore change in debt was no more than 1 or 2 or 3% of GDP, then you could not include that data in your model and fit them with data fairly well. Okay, the error of leaving out the credit roll wasn't a big error. Because they've ignored it, and they've actually, neoclassical economic theory has promoted debt and said it's great to borrow money. Like what's called the Modigliani-Miller theory tells you that the best way if you're paying tax on your income and you, as a company, pardon me, and you get a interest rate deduction for that, then the best situation for the country is to be 100% debt financed company, 100% financed. That's the mythical model they work with. So that is the vision they have. Of course, it's wrong, but it gets more wrong the more debt you have. So what has happened is they've sat on the sidelines. The debt level's risen through the roof. It's increased by a factor of 5 or 6 for most countries between the end of the Second World War and now. There was a credit crunch, huge collapse in demand. That was the 2008 crisis. Some countries avoided that by continuing to borrow money, and Australia was one of those countries. But the ones that had it, they're now in the aftermath of this. There's only a tiny amount of credit demand because people are already scarred from the past process. These are not economists, of course. These are real people. They don't want to borrow money. Therefore, credit demand is low. And what you're going to get is stagnation in the overall demand because that credit component's disappeared or fallen to much smaller levels. So that's the situation that most of the world is in. And therefore, demand is low. And then when the central banks look at their little models that don't include this, they think, oh, there's a bit of a revival going on. We better put up the interest rate to reduce the potential for inflation. They put the interest rate up and people have a much larger debt servicing burden. Yeah. They stop borrowing money or they start repaying it, go back into a slump again. So that's the situation I see us as being in.
And I want to talk about government debt shortly as well. But how bad do you think the situation is in Australia? We read about all the fraud that was happening in the housing market and the taps were just opened, $1 million mortgages and so on. And now that's really been shut down. So what are we seeing so far with that credit impulse or the rate of growth slowing down? And how hard do you think it is going to hit Australia?
Oh, it's only just started and it's going to get much, much harder. So like in Australia's case, the level of private debt has risen, as I said, from historically from about 40% of GDP at the end of the Second World War to 200%, and now it's falling once more. And what we're seeing in terms of the rate of change of debt, which is credit, that's down to of the order of 1 or 2% right now of GDP. The change in the amount of credit is hitting minus 2% of GDP. Now, that's the one that's actually undoing the housing market because when you, I'll explain the logic later if you like, but what drives rising house prices is a rising level of new mortgages.
Yeah.
Now, that's gone by the wayside. That's not going to happen again. So it's then going to negative, and as you get negative, then you get falling prices. And there really is, strictly speaking, it'll end at some point, but that rate of change of new mortgages can go 5 to 6 times as negative as it currently is. Yeah. And that's what will drive house prices down.
I read the other day, foreign investors were, I can't remember if it was 30 or 40% of all new mortgages, and that has dropped to below 10% now, which is just crazy as well. So let's talk about government debt. And at the moment, everyone's has this austerity battle, and your theory is that it's these sort of times, particularly in Australia, where government debt is relatively low, that they need to be spending more while the private user unwinds their debt. Is that right?
Yeah, I mean it's a complex story, and there's lots of myths involved. You got the Austrian extreme. You get the myth that money should be gold, and money really is gold, and therefore all this stuff is going to come a cropper. The neoclassicals start with the myth that, and if we all rationally know that any increase in government spending, so that there's a deficit, must be matched by a future surplus of precisely the same amount in net present value terms, some way in the infinite future, say in the year 32,416, we know that there's going to be an increase in taxes then to make up for the change in government spending now, and therefore we put aside money so our descendants in 1,000 generations can pay that tax because we're altruistic towards our future descendants. I am not joking. I wish I was. But this is the nonsense you read in economic theory. And so they've got that myth. What I'm focusing on is the real accounting, what's actually going on. How do you actually create, how does the government finance itself? And fundamentally, a government in a country that issues its own currency has a central bank. The central bank is notionally independent, but ultimately the central bank can finance whatever the government wishes to buy, whether that's a good or a bad idea, okay? And that means that if the government wants to, let's say the government works out what its spending is going to be next year, given its current plans, what it thinks its revenue is going to be. If there's a gap between the two, and there almost always is a gap between the two, if the spending exceeds the expected tax ratio, then they issue bonds, or they go to Parliament, they pass their supply bill. The supply bill includes the issuing of these bonds. As soon as that's done, the central bank treats the government as having the money, which is completely different to you and me. If I issued Steve Keen bonds to finance my renovations here, I couldn't then go down to a hardware shop and say, here's my Steve Keen money to buy it. No, sorry, I want euro. I have to sell the bonds before I got the euro. Once the central bank does it, I'm not talking the euro now, I'm talking a country like Australia that issues its own currency, then bang, they can spend. Now, how do they finance the interest on that? It's an accounting operation.
Yeah.
Okay. So all this stuff means because the government, when it issues the bonds, is actually creating money that gets put into the economy if the central bank purchases those bonds off the financial sector. If it doesn't, then what the bond sales do, because they're always made to the financial sector, is tap money which is accumulated in the financial sector through people saving, et cetera, and put that money back in circulation in the real economy. Yeah. So normally what a government deficit does is provide more money for the private sector. Yeah. Now, that's the opposite of what neoclassicals say. They think a government deficit takes money away from the private sector. But in accounting terms, it's completely true. The government does that. It actually is injecting money into the economy.
Yeah. So I want to talk about kicking the can down the road. And a lot of people say, why can't they kick the can down the road? They did it since 2008. Do you argue that all that money went into the banks, and as they said, they created a lot of money, but it's pushed up asset prices, and we've seen the wealthy probably benefit more, a lot of people would argue. So how do you see that playing out if they try this again, or is it sort of, we can't do this anymore?
Well, that comes down to what the money is actually being used for. And what you're talking about there is effectively quantitative easing. Yeah. Of course, that's been tried, and there's been the UK, Europe, Japan, and America have all done quantitative easing. Now, what that piece of jargon means is that the central bank tells the finance markets that every month it's going to be on the buy side of what they call open market operations to the tune of X dollars, X euro, X yen. Now, I know the American data very well. And when Bernanke started quantitative easing, he told them they're going to be on the net buy side in those open market operations they're doing all the time, but the open market operations let them control the reserve rate of interest. And there's actually a very good video, I must say, from the Reserve Bank of Australia explaining how using reserve purchases and sales, they put a collar around the interest rate so that they guarantee the low end of interest rates, which is what's paid for short-term government bonds, will be within their target range. Very, very nicely explained video. So they're doing it all the time to maintain that reserve rate. Now, what they do with QE is to say, we're going to do that, and we're going to buy, in America's case, $80 billion of bonds off the financial sector every month, which is $1 trillion worth a year. That's a huge amount of money. Mm-hmm. Now, you think what's going on? That means that the central bank, how does it do it? It simply says, we're putting $80 billion per month in the bank accounts of financial institutions. In return for that, they put $80 billion worth of bonds in our accounts. Now, that means we're putting real money and they're giving us shit. I'm being slightly facetious there, because a large part of those purchases are mortgage-backed securities, corporate bonds, a whole range of stuff that the central bank wouldn't normally buy, that they have been buying now. Now, that, when you look at where that goes, that's injecting money not just into the financial sector, but also into the corporations, who are now selling their bonds more easily than they were beforehand. That does stimulate the domestic economy. You also get the financial sector charging small fees, very small fees, for doing, or maybe 2 or 3%. Yeah, what's 2 or 3% of 80 billion between friends, honestly? So they do that, and that, pardon me, with some invaders on my desk here. That's, we've got an ant infection. I've got to tell my girlfriend about this later. Not going to be good. Summer's coming in, and the animals are moving into Amsterdam houses right now, so I'm finding out the hard way this morning. So they are doing this transaction, and generally speaking, that the majority of the money, say $1 trillion per year, is created by putting the money in the financial sector accounts, putting the assets on the asset side of the central bank as well. So they've created the money just simply by saying, we're making the entry in your books. Now, looking from the financial sector's point of view, that means they've got $1 trillion of cash going up on their asset side and $1 trillion of bonds going down on their asset side. Now, financial sectors make money by purchasing financial assets which give them a return. So what the central bank has done is take $1 trillion worth of bonds out of their hand and give them $1 trillion in cash. Now, where are they going to go? Share market purchases, property purchases. So that's what's actually caused the huge bubble in the stock exchange in America, and it's still happening. So that's what they've been doing. Now, is it sustainable? Well, unfortunately, yes, because there's no limit to their capacity to create that money. They just chose $80 billion a month out of thin air. They could have chose 10 billion. Yeah. They could have chose 200 billion. Yeah. There's no limit to what they can do. So what I think they're doing is they thought that they did this because they thought they'd get what they call the wealth effect. Because people are wealthier, and these people are ordinary people like, you, me, Goldman Sachs' chief executive. I mean, of course, it's not you and me. We don't own shares. Yeah. Okay, it's the wealthy who've got the money. And they think the wealthy are going to spend more money and stimulate the economy. Now, they've actually disproven this in their own research. Yeah. Okay, the only way in which increasing what they call the wealth effect actually causes people to spend more money is when it's housing wealth, because you and I own houses, okay, and people treat the bank, but it's garbage. Yeah. What it's done is dramatically push up the value of shares, which benefits those who own shares who are the wealthy.
Yeah, the Fed minutes came out from, I think it's 5 years, the wait time, isn't it? And they openly admitted, and that was back in 2013, 2014, that this wasn't working. It was creating inequality, and it's only got worse since then. So I really do wonder how this is going to play out, because I think a lot of people go down that path of Armageddon, it's all going to crash. But personally, I think central banks aren't going to let it. They're going to do something more crazy than last time, and we're going to just see huge increases in assets. And as long as that's paying people's retirements and all that sort of thing, I think we're going to see big inflation.
Well, I think it's the asset price inflation, not consumer price inflation, because again, this is, again, you've got people managing the system who don't understand how it works. They have a model of how it works that is wrong. Yeah. Okay. So they did think, and they were correct, that if they purchased these bonds off the financial sector, that would drive up financial assets. They were wrong to think that would cause a wealth effect, because the only wealth effect that matters is house prices, not shares. But it's made a lot of people dramatically richer, who were already rich in the first place, and they will spend some of that increased gain. So people who had shares, who sold them to the financial institutions, if they bought those shares back when the S&P was 666, which was its minimum value, I survived. 666. It's now over, 2,000. Well, they've made a fortune. They've sold those shares to the financial sector. They've capitalized. They've transferred those paper gains into real gains. They've spent some of the money. They've done very nicely, and the economy's got a stimulus out of it. But the Fed, and that has what's actually caused that major revival in the American economy over the last 6 years. However, as soon as the Fed does the process, wants to do quantitative tightening, which is what they started doing late last year, QT reverses QE. So rather than, they mentioned they do it at the same scale. They did, and they're working at about, I think, between 20 and 50 billion a month rather than 80 billion. Yeah. So 20 billion sales versus 80 billion purchases. When they do that, let's say that's running at, let's say it's 200 billion per year. That means that they're selling 200 billion worth of bonds to the financial sector. The financial sector's holding of bonds goes up. How do they do that? They've got to use cash. How do they get the cash? They sell shares. What happens when they sell shares? The market crashes. And now you've got the central banks that have pushed the market up from 666 to about 2,000. Seeing the stock market crashing, we had the serious downturn, across the change of year. Oh, hell, can't have that. What do? We reverse QT, back to QE again. They did that. They also thought that the economy is recovering because they're getting these great unemployment numbers that are much better than the economic growth numbers, but still, let's leave that aside for a second. So the response to that was, we're getting back to the normal range now. When wages get to this level, there must be inflation. Therefore, because we want to get ahead of the game and stop inflation happening, we're going to put rates up. And their target was 4%. Yeah. Now they start doing it. If you're running with America running a private debt level of 1.5 times GDP, which they're completely ignoring, that's increasing the servicing cost by 6% of GDP from going to 0 to 4%. That 6% increase screws the private sector. It can't afford that extra servicing cost. People start liquidating debt. Credit demand goes, the economy goes into a funk again. Oh dear, we've got a reverse direction. That's what they're going through right now. And they're repeating the same mistakes that Japan made back in 1990 to 2015.
Yeah, I think Jerome Powell, I think I said openly on my channel that I kind of respected him and I didn't think he was going to be at the mercy of the markets. And then that U-turn, even I didn't see it coming that quickly about backtracking everything they did. So what is your base case scenario for the US and Europe? And do you think Australia is going to play out any differently? And do you think we do see that inequality if we have asset prices rising but we don't get inflation? We're seeing yellow vests, and do you think there is civil unrest where people say, hey, this isn't working, and central bankers are even admitting that this isn't working now?
I think it's really the case, and it's looking at what happened with the yellow vest movement. I'm actually one of the documents I'm writing right now is for the yellow vests on how do they get out of the bind they're in. It really involves a massive debt jubilee and then redistribution of ownership of capital through the debt jubilee. But yeah, they're getting screwed. I mean, people have been pushed down by neoliberalism, trashing trade unions, so you no longer have the capacity to bargain. Rather than having a union rep and talking to Jeff Bezos, you've got to talk to Jeff yourself. Well, that's going to happen, isn't it? Not. So what happens is nobody dares ask for a wage rise. And the only reason you get wage rises is when the market gets so tight that firms are having to offer higher wages to attract people to come and work in their factories or their warehouses. Yeah. And therefore, at the very end, you see a spike in inflation. So I did expect that to happen. I did expect a spike in inflation to occur as unemployment falls. But the economy is so fragile that as soon as the rates rise, which is the policy change of the Federal Reserve, that cuts back credit demand and unemployment starts to look like it's going to rise once more. And they've got to take their foot off the interest rate bargain. But I can actually give you a few answers to your questions there. Just give me a second.
I was just going to say, while you're looking that up, do you think it plays out any different in Australia? We saw them give the people money in 2008 or 9. Government debt's pretty low. Or do you think Australia is going to be a pretty hard landing with all the speculation that's going on in the housing market?
Oh, it'll be a hard landing. I have no doubt about that. Because, again, they don't realise what's actually happening in the system they're managing. So they will just pardon me, talking, I'm changing your graph as I'm talking. Yeah. They will just go on and do exactly the same thing that the central bank did in America. They're sorry to repeat the same stuff. There's no imagination. I'd never accuse the Reserve Bank of Australia is suffering from an excess of imagination. So they will simply do what's been done by the other central banks around the world.
And do you think it's going to take another financial crisis for them to really have a shake-up and say maybe we're not understanding this system that keeps letting us down, getting blindsided by these financial crises?
I wish even that would happen, but I'm just reading these documents from the Reserve Bank. The capacity of people not to learn from a crisis when the crisis comes from an event that is outside the mental paradigm they have. They just don't learn at all. Like I mentioned Dr. Tulip earlier on with his paper on a model of Australian house prices. Dr. Tulip also wrote a report for the OECD back in 2008, which extolled the virtues of Iceland's financial system and said the only thing Iceland needs is more deregulation. He wrote that in 2008.
Yeah.
Now, that's before Iceland's system completely crashed. The country was facing about a 10-time increase in its debt level if it bailed out all the depositors, most of whom were not Icelandic. Yeah. They were going to do it, and then the Icelandic population, which is about 300,000, a substantial fraction of them, I think about 50,000 people, so something close to 20% of the population, surrounded the parliament and basically said, you do that and the pitchforks are coming straight in and we've got them here. This is not metaphorical. Yeah. I've forgotten the actual ruling system in Iceland, but the governor or whatever said refused to sign the bill. and therefore they defaulted on all their debts.
Yeah.
And that default means Iceland got out of the crisis it was in, doing the exact opposite of what need. This is so the guy who wrote this in 2008 is now in 2019 building a model of the Australian housing system, leaving out the role of private debt and credit.
Yeah,
that is the level of paradigmatic blindness we're dealing with here.
It really is scary.
It is scary. I want to show you some graphs here.
I can't see your screen. That's all, Steve.
You will in a moment. I was going to do that and just share screen if I can.
Oh, fantastic.
If I can't, we'll talk on anyway. But let's see if I can do the share screen here. Done a very large. I've got a gigantic screen. Okay, share screen. Select window screen. I'll go for the MathCAD.
Whole screen. If you want to click on that, it should work.
Okay, can you see my screen now?
We can, yes, thank you.
Okay, now the scale of the text is rather small. I better point, this is 200% of GDP, the level up here. Yep. And this is Japan's private debt level, starting back in 1965, reaching a peak of 225% in 1995, I think it is, and then heading down now to much the same level as America or the UK right now. And this is credit, which was peaking at about 40% of GDP before that's 1990 there. And then you have a kind going through zero, hitting minus 15% of GDP, and then fluctuating mainly negative, sometimes positive, right out till today. Now that's the situation of Japan. And you would have liked to think we'd learned from that. Well, we didn't. Let's go from Japan to the USA. There's the USA. We're now looking over, this is going right back to 1834. That's what's called the Panic of 1837. That's the Great Depression, and that's where we are now. And from the Second World War, which starts here, out to here, we went from a debt level of about, I'll just actually track the data there. I'm not doing this as well as I can. I should have been more prepared, but that's a debt level of 36% of GDP. It peaked at 170% of GDP. During the financial crisis, it fell to 145%, 147%. It's now back up to about 150%, but you can see even that little squiggle here, it's already starting to fall once more. There's the plunge in credit from plus 15 to minus 5, up to about 7% right now, but it'll never get back to these levels again because we've already climbed Mount Everest, fallen off the peak, landed back at the base camp. You're not going to climb all that rapidly again after that experience. That's the situation America's going through. And to show Australia...
So your base case really is for the developed world to be Japan for the next 20 or 30 years?
Yes, that's the expression I've been using for a long time, is turning Japanese. That's what we've all done. Yep. And because the paradigm of the economists who dominate policy doesn't include any role for credit, this keeps on happening and they don't know what's going on. Here's Australia. This is going back to I think this is back to 1860 in Australia's case. So that's 1860. Yep. There's the 1890s crash, which was far worse for Australia than the Great Depression, which is here. And here's where we are today. And as you can see, there's negative credit for Australia back at the time of the recession back in the 1990s, the recession we had to have, according to Paul Keating. That was the boom we had during the global financial crisis. Australia stopped credit going negative by the huge stimulus it did, plus also the first home owners grant and so on. Yeah. That's the boom we've been through. We're now heading towards the decline. So we continue repeating this process. I should go back to...
That's all right. I think that's been really well explained for people at home today, and we've been going for 40-odd minutes. So any final thoughts for people at home? What do you recommend to do for the average person at home that's watching this that might have too much credit card debt, too big a mortgage?
Well, if you're living in your own house, don't sell it. If you like living there, okay. I sold mine for reasons of a divorce back in 2008. I couldn't say that at the time, but that's why I sold. It had nothing to do with my economic predictions. I just didn't want to pay my ex-wife enough to buy somewhere for her to live. But if you got properties that you're hanging on to because you think it's going to be a capital gain, get out. It's not going to be a capital gain. I've written see in Australia's case and Canada's case as well, 2 to 4 years of falling prices. And then a turnaround, which is what happened with the American data, because what actually determines house prices is not the level of debt or the rate of change. It's the rate of change of the rate of change. Now, you can actually have that turn positive when the level of credit's still falling. And that's what happened in the American data. So you can see a very nice correlation between change in the change of mortgage debt and change in house prices. And while the change in mortgage debt is still negative, the change in the change can be positive, and that's what's given a revival in American house prices in the last few years. So it will turn around, but for the next 2 to 4 years, I'd get out of the market.
Fantastic. Well, I love having you on, Steve. I'm sure we'll have you on again soon, particularly when things start to get interesting in Australia. But thanks so much for joining us, and I'll put all the links in the description below for people to follow and support your work.
Thank you very much, mate. Bye.
Cheers, guys.